Hello, Pat and Greg here at NewEdge Wealth. Today we have a special guest, Mark Lieb from Spectrum Asset Management. Mark runs the Principal Spectrum Preferred Institutional Fund, which is a preferred bond fund, or excuse me, preferred equity fund that we have been investing in for 10 plus years. I have known Mark personally this entire time. He is the king of preferreds. He is the largest manager in preferreds. He has had an outstanding track record. The fund we're talking about, the symbol is PPSIX. So with that, I'll give the first question to my partner, Greg.
Thank you, and thanks for being here. Great to talk to you.
My
If
pleasure.
we could start, maybe you could just explain to us what is preferred equity, why is it an interesting asset class, and why is a mutual fund structure the best way for clients to invest?
Well, the preferred marketplace really got started during World War II, which was how companies raised equity for the war effort. And it has grown since. It's used by utilities, it's used by banks, it's used by insurance companies. Basically, is part of the balance sheet and in creating capital. On the bank side, it's part of Tier 1 capital. Same thing with the insurance side, as part of their tier capital system. And the utilities, it's also a part of their capital structure and the balance sheet. Utilities, and the utility side of the market, the coupon is part of the cost of capital for utilities, and it gets figured into the rate base. So it's a unique product. The market is small relative to other types of fixed income. It's about 550 billion in size, which is a fraction of municipals, fraction of corporates, fraction of emerging market debt, and obviously the treasuries.
It's a quirky asset class, a little bit like parts of the muni market. How have you been able to, consistently outperform a benchmark? As Pat and I always say, we don't like to pay active fees unless we really have confidence that the manager can, and you just consistently have.
So, a lot of fixed income managers, a lot of these, trying to figure out where rates are going to go. The preferred market, because the way it's developed, especially with the reset feature, you can bring these durations down to 3.5 years. So it takes the idea of guessing where interest rates are going to go out of the equation. And I've yet to, in my 47 years, meet anybody that has been right about interest rates all the time. So it eliminates one part of that. And the other thing part of your question is that a lot of these prefers, not all of them, but a lot of them have what we call qualified dividend income. So the income on the portfolio is taxed at the capital gains rate, and that's taxed at a lower rate. Instead of the ordinary income at 37%, it's taxed at 20%. So you have a significant after-tax income versus just say, buying bonds.
So basically, so today, client comes in, they buy the portfolio last year. You've got a 2.5, 3-year duration, so you're not taking a lot of interest rate risk in the portfolio. Tell me, I know you bought a lot of bonds at discounts that are going to come due at par. Talk to me about what does a portfolio look like today? What's the yield? Where do you think the yield's going?
I think, right now the yield, say 6.25. We still have a lot in the portfolio at discounts, not as discount as there was. We still have a lot of stuff in the 95, 96, 97, 98 range. In the next couple of years, the next 24 months, the 35% of that portfolio is going to either be called or reset. And each issuer is different, so it's hard to predict. But even Citigroup called one of their preferreds a couple of weeks ago and reissued. They had a 5.5 coupon. They reissued at 675, 680. So even if they reissue and we get called away, there's still a yield pickup. And I could see the portfolio, drifting up about, in the next year or two, up another 50, 60, 70 basis points. As these things, and we position it as these things, either they're going to get called at par and reissued, or they're going to allow it to be reset. And there's no formula to it. Each issuer has to look at, their balance sheet. They have to look at their cost of capital. They have to see how much it's going to cost for investment banking fees to get called in and have it reissued. versus if it gets reset. Again, each one is different, and sometimes they'll wait until 2 or 3 of them are callable. So, but it's, we study that and we watch that very closely. But, you're going to run a 3.5 year duration of a 6.5%, yield in the next 12 to 18 months with a low duration. And you're going to run about anywhere from 50 to 60% at a lower tax rate. And everything we buy, by the way, is investment grade at the senior debt level. This is not a high yield fund. Doesn't trade like a high yield fund, and which is a multiple size of our marketplace, multiple, about 10 times the size, at least, if not more.
So the product, if for a new investor in the vehicle, you're getting tax preference income. Your after-tax return is actually better than munis. Your duration is really low. The odds are most likely is that your cash flow is going to rise about 0.5% over the next couple of years because of the way the resets work in the portfolio.
At least that,
Yeah. Because that means it's going to be closer to 7%, and you're going to be paying the dividend rate of 20% on a lot of that yield. Not all of it, but a lot of it. It's an investment grade asset class. It is a distinct, unique, small niche. And you're coming off a 9% year where the market did 1% last year. So you obviously outperformed last year. After fees, that's after your fees, which are, a little on the high side, but we know we don't like paying fees. That's part of our deal. We hate fees, and we always try to negotiate fees down. So we look forward to you guys lowering your fees one of these days.
We'll get to that at the next mutual fund board meeting. So
it's just, no, and I think you gave us a really great, complete answer, and I really appreciate the consistency of your product, the fact that you're doing exactly what you say you're doing, that your tax preference, that it's a great niche. And this is a place where, we really care about fees and we pay for active management here. So thank you, Mark, for working with us, for your friendship over all these years. And just how quickly you guys answer our questions when we have them. We really very much appreciate that.